Have you ever stopped to think about how finance would even work if interest just wasn't part of the equation? I mean, what if earning interest or paying it was actually seen as, well, wrong, unethical even? Today, we're doing a deep dive into exactly that. We're exploring the really fascinating world of Islamic finance. Our goal here is to unpack its unique principles, try to understand how it actually operates with some pretty innovative products, and then, take a critical look at the benefits and the challenges, both for the institutions offering it and for you, the users.
Yeah, and we're basing this discussion on a follow-up article we found. It builds on some earlier talks we had about things like Sukuk bonds. But this gives us a much broader view, a more general overview of this whole global financial system. Okay, so let's kick things off. Let's look at the ethical foundation, the blueprint underneath Islamic finance. It really insists on ethical behavior, fair treatment. In all business dealings, it's not optional. We're talking honesty, integrity, truthfulness, morality, absolutely non-negotiable. So businesses, for example, shouldn't profit from someone else's misfortune.
Or take unfair advantage. Like, you can't just charge a higher price because the buyer doesn't know any better. And a really key point here is that any profit made, it should ultimately benefit society, not just the individuals or the company involved.
And what's really distinct, I think, is how these broad ethical ideas translate into very specific prohibitions. These really define the framework. Take money itself, or gold and silver. In Islamic finance, they're not commodities, not things to be traded for profit in themselves. No, they're seen purely as a means of exchange, just a tool.
Ah, okay. A fundamental difference.
Exactly. And because of that, charging or receiving interest, the term is riba, is strictly forbidden on loans. And beyond riba, there are other clear bans. No dealing in things considered socially harmful.
Right, like alcohol, pork, weapons.
Weapons, gambling, those sorts of things. And another big one is speculation. That really limits the use of, say, complex derivatives or many money market activities that are essentially built on interest.
Wow, okay. That is a massive departure from conventional finance. So if money isn't a commodity and interest is out, how does money actually flow? How do investors connect with borrowers? How do projects get funded?
Well, stepping back a bit, the fundamental answer Islamic finance gives is partnership. Profit-sharing arrangements or partnerships based on shared risk.
Partnership, not lending.
Precisely. So Islamic financial institutions, IFIs, they don't just take your deposit like a loan and pay you interest. Instead, they channel those funds into actual underlying investment activities, things that generate real profit. And then you, the depositor, you get a pre-agreed share of that profit after the IFI takes a management fee, of course.
Okay, so the depositor becomes more like an investor.
In essence, yes. And IFIs can also raise capital through specific equity-type contracts. The main ones are called Mudaraba and Musharaka. In these structures, you have the investors, the rubble mall, they provide the funds, and then you have the investment manager, the Mudarab, that could be the IFI itself, or a corporation using the funds. The whole emphasis is on genuine partnership. Profits are shared according to agreement. And crucially, sometimes losses are shared too, if the venture doesn't work out.
That is a fascinating shift. From lender-borrower to, partners. And these core ideas, they've led to some really specific products we see used widely. How do they actually manage finance without interest? Let's maybe group them a bit. Okay, first let's look at the equity-based ones, the partnership products. Mudaraba contracts, for example. They're a bit like venture capital, maybe.
That's a good analogy.
Right. So one party, the rubble mall, the investor, often the IFI, puts up all the money. And the other party, the mudarab, the entrepreneur or manager, provides all the expertise, the labor. If it's successful, great. They share the profits based on whatever ratio they agreed beforehand.
But here's the key difference, especially with Mudaraba.
Okay.
If there are losses, assuming it wasn't due to misconduct or negligence by the manager, the mudarab, then all the financial loss is borne solely by the investor, the one who put up the capital.
So the financial risk is really concentrated on the capital provider in that model.
Exactly. The mudarab risks their time and effort, but not the capital directly.
Got it. Now, what about Musharaka? You mentioned that too.
Right. Musharaka is more like a true joint venture. Think of it that way. Here, both parties contribute capital. Or it could be assets, maybe even services. And they both actively participate in managing the venture.
Okay, so shared contribution, shared management.
And therefore, shared profits and shared losses. That's the critical part. Losses are shared proportionally to each party's contribution.
Right, that makes sense. More balanced risk.
Then there's a variation, quite an interesting innovation actually, called Diminishing Musharaka.
Diminishing? How does that work?
It's often used for things like home financing. Imagine you and the IFI jointly buy a house. Over time, you make payments that include partly buying out the IFI's share and partly paying them a profit share for the portion they still own.
So you gradually increase your ownership stake.
Exactly. You gradually pay down their share until eventually you acquire full ownership of the asset. It diminishes their stake, hence the name.
Clever. Okay, so those cover the partnership or equity side. But what about things that feel more like, fixed income products? How do they avoid interest there?
Yeah, that's a good question. The key distinction here is that these products are almost always asset-backed or based on trade. They involve a tangible asset changing hands. Murabaha contracts were probably the most common example. It's basically a cost-plus sale.
Cost-plus.
Yeah. The IFI buys a specific asset that the client needs. Let's say it's a piece of machinery for their business. They buy it, then immediately sell it to the client. The price is the original cost plus an agreed-upon transparent profit margin. The client then pays this total amount back in installments over a set period.
Okay, so the bank owns the asset for a moment, then sells it on credit, effectively.
For a very brief moment, yes. Now, this one has caused some debate among Sharia scholars.
Oh, why is that?
Well, some argue it can look like creating debt on debt. The client takes on a debt to the IFI for an asset the IFI bought, possibly on credit itself initially. The concern is whether this just mimics interest, creating a debt obligation that grows, even if it's linked to an asset sale. It could risk layering debt.
I see the potential issue there. How is it usually justified?
The justification is that there is a real underlying asset being traded. A genuine sale occurs, and the profit margin is fixed and transparent upfront, unlike fluctuating interest. And frankly, there's also a pragmatic argument. To compete with conventional finance, they need mechanisms that offer similar outcomes, and benchmarking against market rates, while controversial to some, is often seen as necessary.
Right, the competitive reality.
Exactly. Then you have Ijara contracts. These are very much like a conventional operating lease. The IFI buys an asset, say, equipment for the client to use. The client pays regular rental payments for using it.
So like renting.
Pretty much.
Okay.
But crucially, the owner, the lessor that's the IFI, remains responsible for major maintenance, insurance. They bear the ownership risks.
Okay.
And often at the end of the lease term, the client, the lessee, might have an option to buy the asset for a nominal sum.
And Sukuk, which we've touched on before, often use structures like Ijara, right? Securitizing the rental income from assets.
Precisely. Sukuk often represent ownership shares in assets leased out under Ijara, or profits from Mudaraba or Musharaka partnerships. They allow investors to get exposure to the returns from these tangible assets or ventures, rather than just lending money.
Got it. What else is common?
Well, for trade finance, there are Salam contracts. Think of these like forward purchase agreements. A commodity, say agricultural produce or a service, is sold today for delivery in the future, but the seller gets the full cash payment immediately, upfront.
So the seller gets liquidity now for future production.
Exactly. The terms, price, quantity, delivery date are all fixed. The IFI might profit by securing a discount on the future commodity price and then potentially reselling the contract or the commodity later.
But not for money itself?
No, definitely not. Salam is prohibited for gold, silver, currencies, anything that functions purely as money. It has to be for real goods or services.
Okay. And one more, Istisna.
Yes, Istisna. This is often used for bigger long-term construction or manufacturing projects. Building a factory, maybe, or a power plant. Here, the IFI agrees to fund the construction or manufacture of a specific asset according to agreed specifications. The client typically pays an initial deposit, then makes progress payments or installments throughout the construction period.
And receives the completed project at the end.
Exactly. The IFI facilitates the creation of the asset.
That's quite a toolbox of different methods, all designed around avoiding interest and focusing on assets or partnerships. But with all these complex products and underlying principles, how do they actually ensure everything stays compliant? Who's checking? Right, that sounds crucial. This is where the Sharia boards, the SBs, come in, isn't it?
Absolutely critical role, yes. Their entire function is to ensure every single product, every service, every transaction an IFI engages in adheres strictly to Sharia principles.
And what does that involve? What do they actually do?
Well, it's quite comprehensive. They review and approve all new product proposals before they launch. They make judgments on specific, often complex, transactions. Is this particular deal structured correctly? They also oversee Sharia-compliant training for the IFI's staff, ensuring everyone understands the rules.
And they even check the annual reports.
Yes, they typically provide a statement in the annual report confirming the IFI's operations were Sharia-compliant during the year.
Who sits on these boards? It sounds like you'd need a mix of skills.
You do. They're usually composed of respected Islamic scholars, experts in fiqh al-muamalat, which is Islamic jurisprudence related to transactions, and finance professionals, people who understand the practicalities of banking and markets. You need both perspectives.
Makes sense. Religious knowledge and financial expertise.
And it's quite common for prominent scholars to serve on the Sharia boards of multiple institutions. There are also oversight bodies, like the International Association of Islamic Bankers, that help provide guidance and standards.
Okay, so there's a system in place, but it sounds like it might face some challenges.
This definitely raises an important point. Yes, despite their vital role, Sharia boards face some significant hurdles.
Such as?
Well, one major one is interpretation. Sharia law, derived from religious texts, isn't always black and white. Different scholars can and do interpret things differently. So you can get varying judgments on the very same financial product, depending on which Sharia board is reviewing it, or even which region they're in.
So inconsistency could be an issue. What's compliant in Malaysia might not be viewed the same way in the Gulf, for instance.
Potentially, yes. There's ongoing effort towards standardization, but differences remain. Also, precedents set by one board aren't legally binding on others. And even within the same board, if the members change over time, the collective opinion on certain products might shift.
That adds a layer of uncertainty.
It can. Plus, operating effectively requires significant resources. Especially for complex deals like structuring Sukuk, the due diligence and analysis needed are substantial. And, of course, the members absolutely have to stay up to date with everything happening in global finance. Markets evolve so quickly. Making relevant rulings requires deep, current knowledge.
So what does this all mean when we step back and look at the big picture, Islamic finance? It's clearly more than just, a niche market. It seems to have some really compelling benefits. It definitely pushes for a different kind of business relationship, doesn't it? More like stakeholder partnerships, built on mutual interest, trust, cooperation.
That's a huge part of the appeal, yes. The ethical framework isn't just about avoiding prohibitions. It actively encourages fair dealings that benefit the whole community, not just the immediate parties.
And that focus on fairness and community benefit, it's quite distinct.
And another key insight, I think, relates to stability. Well, by prohibiting speculation, gharar is the term for excessive uncertainty or risk, and banning interest-based leverage that can get detached from the real economy. Islamic finance inherently encourages a longer-term view, focuses investment on tangible assets and real economic activity.
Less focus on short-term financial engineering, more on underlying value.
Exactly. Some research even suggests that financial systems based more heavily on these principles might be less vulnerable to certain types of financial crises. Think about 2008. Much of that was fueled by complex, opaque derivatives and excessive leverage, things largely prohibited in Islamic finance. The focus on asset backing provides a kind of natural shock absorber.
That's a really powerful idea, a potentially more stable system. And beyond the ethics and stability, there's the sheer market access, right? We're talking about a massive global pool of funds.
Absolutely. Estimates vary, but it's well over, $1.6 trillion, and growing rapidly. Accessing funds from Muslim communities worldwide is a major draw.
But it's not just for Muslim communities, is it?
Not at all. The ethical investment angle is increasingly attractive to a much wider audience. Many non-Muslim individuals and institutions are drawn to investments focused on social responsibility, tangible assets, and shared risk.
So ethical appeal is broadening its reach.
Definitely. But what's fascinating here, and we need to be balanced, is that alongside these benefits, there are also some pretty significant drawbacks and challenges, especially for the IFIs, the providers.
Okay, let's unpack those. What challenges do the institutions face?
Well, first, flexibility and responsiveness. Because they can't use interest or engage in speculation, IFIs might find it harder to react quickly to market shifts compared to conventional banks. They might lack some of the tools conventional banks use to manage liquidity or hedge risks quickly. Seizing very short-term opportunities might be more difficult.
So potentially less nimble.
Potentially, yes. And then there are costs. Because the relationships are often closer partnerships, requiring more insight into the underlying business, the due diligence and negotiation costs can be higher, There's inherent information asymmetry they need to manage carefully.
More homework needed for each deal.
Pretty much.
Yeah.
Plus, developing new products is inherently more expensive. You have the double burden. Comply with standard financial regulations and get Sharia board approval.
Right, that two-stage process.
That approval process, involving detailed reviews by scholars, can significantly slow down innovation. Bringing new products to market takes longer. This might sometimes limit IFIs to smaller markets or niches where they can manage that complexity, or just mean they lag behind conventional banks in product range.
Are there regulatory hurdles too on the international stage?
Yes, sometimes. Certain Islamic finance structures might not fit neatly into existing international financial regulations. For example, how is a diminishing musharaka treated for capital adequacy purposes? Is it debt? Is it equity? Different jurisdictions might view it differently. This can lead to higher legal costs, insurance complexities.
And you mentioned the interpretation issue earlier. Does that cause problems beyond just inconsistency?
It can lead to criticism. Some scholars, for instance, are critical of Murabaha contracts or certain Sukuk structures, especially if the profit rate or repayments end up being benchmarked against prevailing interest rates like LIBOR or SONIA.
Because it looks too much like interest.
Exactly. They argue it becomes economically equivalent to conventional debt, potentially undermining the spirit of riba prohibition, linking returns to market interest rates rather than the actual performance of the underlying asset or venture.
But the counter-argument is competitiveness again, right?
Yes. The counter is that IFIs operate in a world dominated by conventional finance. To be viable, they need some way to price their products competitively, and benchmarking is often seen as a practical necessity, even if theoretically debated.
Okay, so those are challenges for the IFIs. What about for the companies or individuals actually using Islamic finance? What are the trade-offs for them?
Well, I suppose those higher costs we just talked about, development, compliance, due diligence, they likely get passed on, don't they?
Often, yes. Developing and getting approval for these products isn't cheap, so the end cost for the customer can sometimes be higher than conventional alternatives.
So, potentially more expensive.
Potentially. And related to the slower innovation pace, corporations might find they have fewer options available compared to the vast range of conventional products, and maybe less flexibility within the products they do use, again, because of the stricter rules and approval processes. This could make them feel less competitive if their rivals are using cheaper or more adaptable conventional finance. You also mentioned agency issues earlier with partnerships like Musharaka. How does that play out for the corporation?
Right. When an IFI is involved, not just as a funder, but as a partner, maybe even participating in management decisions under a Musharaka, you can run into classic agency problems. The IFI's objectives as a financial institution might not perfectly align with the corporation's long-term strategic goals or the goals of other stakeholders.
Potential conflicts of interest, basically.
Yes, or just different priorities leading to friction. It's a challenge inherent in any structure where ownership and management diverge, but perhaps more pronounced when your financial partner is also formally involved in running the show.
Any other issues for users?
Market liquidity can be a factor. Trading in the secondary market for things like asset-backed Sukuk has sometimes been limited compared to conventional bonds, although it's improving. And new Sukuk issuance actually dipped for a while after the global financial crisis, though it's picked up again since.
Okay, and maybe a final point. Cost of capital.
That's a potentially significant one. Conventional debt often comes with a tax shield. The interest payments are tax deductible for the corporation, lowering the effective cost of borrowing. It can be harder to argue that payments under Mudaraba, Musharaka, or even some Sukuk structures are equivalent to interest for tax purposes.
So they might not get that tax benefit.
They might not, depending on the tax jurisdiction. If they don't get the tax shield, their overall cost of capital could be higher than a competitor using conventional debt, which could, in theory, lower the value of their investments or the firm itself.
So quite a few practical considerations alongside the ethical appeal.
Definitely. If we connect this back to the bigger picture, though, Islamic finance is undeniably growing in importance globally. It's a significant source of funding that organizations need to be aware of. Its ethical foundations, the focus on partnership and real assets, make it especially appealing, as we said, not just to Muslims, but to anyone interested in socially responsible investing.
And it's not static, is it? You mentioned innovation.
Not at all. We're constantly seeing innovation. New types of Sukuk are being developed. Structures like Diminishing Musharaka are becoming more refined and widely used. The field is definitely evolving to meet modern financial needs.
But this raises that important question again. while it's promising, while it's growing, these challenges for IFIs, the agency issues, the costs, the flexibility constraints, that dual compliance burden, they're real.
They are. And tackling them is crucial.
Yeah, it seems absolutely critical that the IFIs themselves and the regulators overseeing them really develop clear strategies to overcome these hurdles. They need to find ways to streamline processes, maybe achieve greater standardization and interpretation, manage costs.
So that Islamic finance products can genuinely compete head-to-head on a practical level with conventional riba-based finance.
Yeah.
That's the ongoing task.
So let's leave our listeners with a final thought. Considering everything we've discussed, that deep emphasis on ethical partnership, on sharing profits from real activity, on benefiting society, if these principles were adopted more broadly, even beyond specifically Islamic finance, how might that reshape not just our global financial systems, but maybe even our fundamental understanding of economic justice and how we think about creating and distributing wealth itself? Something to ponder.